clearly the inflation narrative has dominated the first half. Maybe the recession narrative dominates the second half. The key question, though, is how do you not lose money in the second half of the year? Let's bring in to try and answer that question Jay Hatfield, Infrastructure Capital Advisors Portfolio Manager and CIO. Jay, happy 4th of July. Thanks for joining us bright and early this Monday. Let's talk about the second half of the year. The first half, very, very bumpy. How do I avoid losing money in the second half?
Hi, Guy. It's great to be on. Happy 4th. The first thing is that there's one critical element that almost every investor is missing globally, and that is that the Fed is not behind the curve. They actually have been neutralizing their bond purchases for over a year and shrinking the monetary base this year by almost 15%, which is the fastest since the Great Depression. So if you look at the commodity markets, the Fed has actually brought down these PPI type inflation, so commodity inflation, by 20% over the last month, driven by the lower monetary base, which drives the dollar up 10%. So we think that the second half, at least the market will figure that out. The risk is the Fed is perpetually behind the curve. They're more Keynesians than monetarists. So they may be the last to figure out that they've curbed inflation. So that's a risk. We think we're near the bottoms. You can definitely enter the bond market. We think we're stabilizing. Probably 3% is the area where we'll stabilize on the 10-year in the U.S. So we think you can make money in bonds, defensive dividend stocks. Probably not time to go into necessarily Bitcoin or profitless tech, but stay defensive. But there's a lot of bargains out there on dividend stocks and in the bond market.
So let's just break that down and figure it all out, because it does sound like it all starts ultimately with some stabilization in the US 10-year. Last week was incredibly whippy. We're now trading 2.884 on the US 10-year. You think, therefore, there's more downside, significantly more downside on that 10-year yield. You think it's going to stabilize around 3%, but there's an opportunity. Jay, just walk me through that bond trade.
Well, so I wouldn't necessarily go buy treasuries, but a lot of fixed income securities. We love crossover preferred stocks that have 7-8 yields. So if the treasury stabilizes, that provides a bid for really all assets. Because keep in mind that the 10-year is really a key driver of the valuation. So for instance, our fair value right now on the S&P is 4,400 at roughly 3% 10-year. But if that went to 4%, it would drop by over 15%. So it doesn't just stabilize the bond market, it also stabilizes the equity market. So we're reasonably constructive. We don't think that the next inflation report will be good in July, because the July report that comes out in a week for June. But the July report that comes out in August, commodities are going to be down 20, even gas prices are down. Our natural gas prices, strangely, are down 33%, while Europe's are skyrocketing. So U.S. inflation should cool off in the fall, particularly after the driving season's over. So we think that's a good backdrop to gradually move into assets. Just beware, September, October is usually volatile. We might test the pre-pandemic levels of 3,400 in the fall, but ultimately buying dividend and fixed income right now is probably the way to re-enter the market.
Just sticking with equities for a moment, though, if we could. The earnings season is soon to be upon us. What do you think that earnings season is going to deliver?
We think it'll mostly be winners, clearly some losers. What a lot of viewers in the U.S. particularly don't appreciate is Europe's loss is the U.S.'s gain. It's not just energy. It's also materials, including steel, chemicals, fertilizer. So you mentioned earlier in the program, there might be shutdowns in Europe. Well, guess where that shortfall is coming from? The U.S. So we think that's a huge support, not just for earnings, but the fundamental economy. We don't think the U.S. is going to have a significant recession. Unfortunately, it's really off the backs of Europe's failed energy transition. But so definitely winners. Also, we think utilities, REITs will be strong. And then some consumer stocks will be weak because we're moving from goods to services.
So Jay, is this the much fabled soft landing?
We think so. It might technically be recession. A lot of people, I mean, we could very well have negative growth this quarter, and then last quarter we did. That doesn't mean it's a recession. That's just one definition. Normally, a recession is characterized by a significant increase in employment, which we just don't see. Again, all of the manufacturing and materials and energy businesses are booming. And also, our housing sector is very strong because we have a shortage of housing. Normally, you have tremendous layoffs in housing. We're not likely to have that. So we might have a technical recession, but not a significant increase in unemployment or defaults. So we think it's going to be a 2001 style, very mild recession. Tech comes down. Dividend stocks do well, at least on a relative basis. So we don't see Armageddon for the U.S. I think Europe is headed into recession, the UK and Italy particularly because they have excess exposure to natural gas. But we're pretty bullish about the U.S., or at least constructive maybe is a better word.
Jay, given all that, but you're saying that you don't think there's going to be a recession or it won't feel like a recession. The labor market is still super tight in the United States. As you say, the housing market still looks very, very strong. You think that we can continue to deliver growth despite the fact that we still have significant supply side issues? I hear what you're saying about the fact that commodity inflation may come down, but nevertheless, it's not just commodity inflation that is driving the issues that we have right now. It's shortages across the supply chain. Manufacturers are complaining about it. We had the ISM data showing that Friday. They're still very much focused on the fact that there are shortages. Why is the Fed not going to continue to hit that issue very, very hard?
Well, we think they are. As I mentioned, they're perpetually behind the curve. They're also, keep in mind that Powell is very much a politician. He was trained as a politician. So we think that they will overshoot like they normally do, and that could risk more of a downturn in the U.S. But if you look at our inflationary expectations, we can look it up on the terminal as implied by TIPS. They've come down a full % over the last 3 months. The Fed doesn't really look at that, which they should. So we think that we're clearly now on a path to reduce inflation, and the commodities are signaling that. But it is a risk, as you're pointing out, that the Fed is, again, looking in the rearview mirror, completely behind the curve, this time on inflation improving. And so they over-tighten, and they keep shrinking the monetary base, which is a huge risk. As I mentioned, fastest decline since the Great Depression. That's not good for stock and bond markets. That's what's pressured us so far. That's what they did in 2018, but hopefully they back off towards the end of the year.
Jay, enjoy the fourth. Thanks for your time. Really appreciate it. Jay Hatfield, Infrastructure Capital Advisors Portfolio Manager and CIO. Thank you very much indeed.